Welcome to this exploration of economic indicators, fundamental tools for understanding the complex world of finance and commerce. These statistical data points are far more than mere numbers. They are the pulse of a nation's economic health. They offer critical insights into current conditions and provide clues about future trajectories. Economic indicators are vital instruments used by a diverse range of stakeholders. Governments, businesses, investors, and even individuals rely on them to make informed decisions. They enable a clear understanding of the present economic state, helping us gauge whether an economy is expanding, contracting, or holding steady. Beyond current assessment, these indicators facilitate the prediction of future economic trends. By analyzing patterns and relationships, experts can forecast potential shifts in growth, inflation, and employment. This foresight is absolutely crucial for strategic planning in every sector. Ultimately, economic indicators are indispensable for navigating the financial world. They empower decision makers to anticipate challenges, seize opportunities, and allocate resources effectively. Without them, economic policy and business strategy would be largely based on guesswork. Economic indicators are broadly categorized into three types, each offering a distinct perspective on economic activity. Understanding these classifications is key to interpreting their collective message. We will delve into leading, lagging, and coincident indicators, examining what each reveals. Leading indicators are perhaps the most exciting category because they predict future economic activity. They signal upcoming changes in the business cycle before they actually occur. These indicators are closely watched for early signs of economic expansion or contraction. One prominent example is consumer confidence. When consumers feel optimistic about their financial future and the economy, they are more likely to spend. This increased spending often precedes broader economic growth, making consumer confidence a powerful leading signal. Building permits also serve as a strong leading indicator. An increase in new construction permits suggests that businesses and individuals are planning future investments. This activity typically translates into increased economic output and job creation down the line. The stock market's performance is another widely observed leading indicator. Stock prices often reflect investors' expectations about future corporate earnings and economic conditions. A rising market can signal optimism, while a sustained decline may suggest impending economic challenges. Manufacturing orders provide insight into future industrial production. When factories receive more orders for goods, it indicates an expectation of increased demand. This often leads to higher production levels and employment in the manufacturing sector in the coming months. The significance of leading indicators cannot be overstated. A consistent rise in these metrics often signals an upcoming period of economic expansion and prosperity. They offer a valuable heads-up for businesses to prepare for growth and for policymakers to adjust strategies. Conversely, a sustained decline in leading indicators suggests a potential economic slowdown or even a recession. This early warning allows stakeholders to take proactive measures, such as tightening budgets or diversifying investments, to mitigate potential negative impacts. Lagging indicators, as their name suggests, reflect past economic performance. They confirm trends that have already occurred, providing a historical perspective rather than a predictive one. While not forward-looking, they are essential for validating economic shifts. The unemployment rate is a classic example of a lagging indicator. It typically falls after an economic expansion is well underway and rises after a recession has already begun. Changes in employment levels take time to manifest after broader economic shifts. Inflation, measured by the rate at which prices for goods and services are rising, is another key lagging indicator. It often accelerates after periods of strong economic growth and demand. Conversely, inflation tends to cool down following an economic contraction. The prime interest rate, set by central banks, also functions as a lagging indicator. Central banks usually adjust interest rates in response to observed economic conditions, such as persistent inflation or a prolonged recession. These adjustments reflect past economic performance. Lagging indicators are incredibly useful for confirming the economy's direction. They provide concrete evidence that a previously anticipated trend has indeed materialized. This confirmation is vital for assessing the accuracy of earlier forecasts. Furthermore, these indicators are crucial for evaluating the effectiveness of past economic policies. If a government implemented measures to stimulate growth, lagging indicators like GDP or employment figures can show whether those policies achieved their intended results. Coincident indicators offer a real-time view of the economy's current state. They move in tandem with the business cycle, providing a snapshot of what is happening right now. These indicators help confirm whether the economy is expanding, contracting, or stagnating. Industrial production is a prime coincident indicator. It measures the output of manufacturing, mining, and utilities sectors. Changes in industrial production directly reflect the current level of economic activity and capacity utilization. Retail sales are another important coincident indicator. They track consumer spending on goods, providing immediate insight into demand and economic vitality. Strong retail sales suggest a healthy consumer base and robust economic activity. Gross domestic product, or GDP, is perhaps the most comprehensive coincident indicator. It represents the total monetary value of all finished goods and services produced within a country's borders in a specific time period. GDP is the ultimate measure of economic output. The significance of coincident indicators lies in their ability to confirm the current economic state. They tell us whether the economy is actively expanding, contracting, or experiencing a period of stagnation. This real-time data is invaluable for immediate assessment. By observing these indicators, economists and policymakers can ascertain the immediate impact of various factors on the economy. They provide the most up-to-date picture of economic performance, guiding short-term decision-making and policy adjustments. Economic indicators are not just academic curiosities, they are powerful tools that drive critical decisions across various sectors. Their insights shape policies, strategies, and personal financial choices. Understanding their impact is essential for all stakeholders. Governments rely heavily on economic indicators to formulate effective fiscal policies. These policies involve decisions about government spending and taxation. For instance, during a recession, indicators like GDP and unemployment guide decisions on stimulus packages. Monetary policies are also directly influenced by economic indicators. Central banks, like the Federal Reserve, use indicators such as inflation rates and employment figures to set interest rates. If inflation is high, the central bank might increase interest rates to cool down the economy. These policy decisions have far-reaching consequences for the entire nation. They affect everything from the cost of borrowing for businesses to the purchasing power of individual citizens. Sound policy relies on accurate and timely economic data. For businesses, economic indicators are indispensable for strategic planning and operational decisions. They help assess market demand for products and services. A rising consumer confidence index, for example, might signal an opportune time to launch a new product. Indicators also guide production planning. If manufacturing orders are increasing, businesses can anticipate higher demand and scale up production accordingly. Conversely, declining indicators might prompt a reduction in inventory or a slowdown in expansion plans. Investment decisions are also heavily influenced by economic data. Businesses use indicators to evaluate the economic climate before committing to new capital expenditures, such as building new factories or acquiring new equipment. A favorable economic outlook encourages investment. Investors, from individual traders to large institutional funds, use economic indicators to evaluate company performance and market trends. They analyze data like GDP growth and industrial production to gauge the overall health of the economy, which impacts corporate earnings. These insights enable investors to make informed investment choices. For example, strong retail sales might suggest a good outlook for consumer discretionary stocks. Conversely, rising interest rates could make bonds more attractive relative to stocks. Understanding economic indicators helps investors manage risk and identify opportunities. It allows them to anticipate market shifts and adjust their portfolios accordingly, aiming to maximize returns while minimizing potential losses. Even for individuals, economic indicators offer valuable insights that affect personal financial situations. They help in understanding the job market. A falling unemployment rate suggests more job opportunities and potentially higher wages. Individuals can assess their personal financial situations more effectively by considering broader economic trends. High inflation, for instance, means their money buys less, prompting adjustments in spending and saving habits. Ultimately, economic indicators empower individuals to make informed spending and saving decisions. Knowing the economic climate can influence choices about major purchases, retirement planning, and debt management, leading to greater financial security. While economic indicators are powerful tools, it is crucial to acknowledge their limitations. They are not infallible and should always be interpreted with a degree of caution and critical thinking. A nuanced understanding is key to their effective use. One significant limitation is that economic indicators are not perfect predictors. They offer probabilities and trends, not certainties. Unforeseen events, often called black swans, can rapidly alter economic trajectories, rendering previous forecasts obsolete. Furthermore, many indicators are subject to revisions. Initial estimates are often based on incomplete data and are later updated as more comprehensive information becomes available. These revisions can sometimes change the perceived economic picture. The interpretation of economic indicators can also be complex. Different economists may draw varying conclusions from the same data, depending on their theoretical frameworks and assumptions. There is rarely a single, universally agreed upon interpretation. Crucially, no single indicator tells the whole story. Focusing on just one metric can lead to a skewed or incomplete understanding of the economy. A holistic view requires considering a broad range of data points and their interrelationships. Achieving a comprehensive understanding of the economy, therefore, requires analyzing a range of indicators. It involves looking at leading, lagging, and coincident data together to form a complete picture of past, present, and future trends. It also necessitates considering their interrelationships. For example, how does a change in consumer confidence leading eventually impact retail sales, coincident, and then unemployment rates, lagging? Understanding these causal links is vital. Economists and analysts often use complex models that integrate multiple indicators to generate more robust forecasts. This multifaceted approach helps to mitigate the limitations of individual data points and provides a more reliable economic outlook. Despite their limitations, economic indicators remain indispensable tools for anyone seeking to understand and navigate the global economy. They provide invaluable insights into the health, direction, and potential future of economic systems. These indicators empower governments to craft effective policies, enable businesses to make strategic decisions, guide investors in their financial choices, and help individuals manage their personal finances. They are the bedrock of informed economic action. By continuously monitoring and critically analyzing economic indicators, stakeholders can better anticipate challenges, identify opportunities, and ultimately contribute to more stable and prosperous economic environments. They are the language of the economy, and learning to speak it is a powerful skill.